Here's 5 ETFs that are better than SCHD and even JEPQ. Investors, yes, I think I found 5 different ETFs that pay dividends that are better than SCHD and even JEPQ to hopefully live off of dividends faster, or at least have more money than you began with in your investing portfolio. These 5 ETFs could either pay you more dividends, have dividends flow into your investing account every single month. The portfolio manager might actively manage your favorite ETF versus passively managing it, which can lead to better returns. These ETFs also have more stable income. There might be better tax benefits, so hopefully you can pay less taxes over time come tax season. And finally, everyone's favorite, which is more capital appreciation to have more money in your portfolio long term to retire rich, healthy, and wealthy. SCHD is arguably one of the best quarterly paying dividend ETFs because it has diversification, high quality dividend paying companies, low fees, a solid dividend yield of around 4%, the ability of the fund to actually grow its dividends year over year, which is great for living off of dividends over time sustainably, of course great and solid returns over time historically, the whole 9 yards. However, though, there has been a recent slowdown in returns of SCHD compared to its competitors, and some investors might want to know of other ETFs that could be better than SCHD that pay a dividend, of course. On the other hand, JEPQ is arguably the king of a cover call high dividend ETF investing, where this fund writes or sells call options on the underlying index of the Nasdaq 100, which is a similar index with JEPQ. So JEPQ has diversification, okay fees, and a great solid income every single month, and of course solid upside potential as well to generate hopefully some solid capital appreciation long term. However, with JEPQ, there are definitely other kings on the block that can definitely challenge JEPQ for the throne of the best cover call ETFs in the stock market right now. So with that in mind, here are 5 ETFs that I think are better in many different ways than SCHD and even JEPQ, so let's get started right now. So let's begin with 3 different ETFs that are better than JEPQ, all in my opinion. First up, we have SPYI or SPYI, the NEOS S&P 500 High Income ETF. SPYI's objective is to provide investors with high, solid, sustainable monthly income. And then the fund does this, distributes the income in a very tax efficient, tax beneficial manner to hopefully have you have less taxes long-term come tax season in your portfolio with SPYI. The company NEOS does this by using what's called index options, which are classified as Section 1256 contracts, where the outcome is your income is then taxed at the 60% long-term capital gains rate, and 40% is taxed at the short-term capital gains rate, so overall you're going to have less taxes because some of it is going to be at the long-term capital gains rate of 60% at a 60-40 tax rate split for lower taxes. Now SPYI invests in legit every single stock from the S&P 500 index, so you're going to have legit all the stocks, every single stock, all 500 stocks from the S&P 500 all in this one fund of SPYI. And then what NEOS does is they're going to sell or write call options on all the stocks under the fund to generate that high juicy monthly income. You're also going to have diversification as well as some solid upside potential because NEOS basically sells their call options more out of the money because they care about the upside appreciation and capital appreciation from SPYI for investors to have the best total returns possible. SPYI has a dividend yield of around 12% and an expense ratio of exactly 0.68% as well. The top holdings are just like the famous S&P 500 index, like Apple, Nvidia, Microsoft, Amazon, Broadcom, and Meta. And then the sector holdings are very diversified from technology, financials, consumer cyclical, communication services, and then healthcare as well, and so much more, of course. This fund of SPYI is a great choice for investors who want stable, sustainable, and safe monthly income in their portfolio every single month. And as you can see, the income every single month is stable and not volatile like JEPQ, making it a great choice for investors who want to live off of dividends at some point in the future. The returns over the last year comparing these 3 funds of SPYI, JEPQ, and SCHD is a very interesting outcome of SPYI actually winning, where this fund of SPYI is actually beating all 2 of these funds of SCHD and JEPQ, returning higher returns to investors to have more money in their portfolio, so SPYI is a very solid choice for investors right now and in the future as well. The second fund is QQQI, the NEOS Nasdaq 100 High Income ETF. QQQI's objective is to provide that high monthly income from selling or writing call options on the underlying stocks from the Nasdaq 100 index. And this fund has what's called diversification and of course solid upside potential from NEOS selling these call options more out of the money than their competitors in the ETF covered call space. Now, of course, in NEOS fashion, the income is going to be more tax efficient than competitors from those Section 1256 contracts to have less income on taxes from this ETF in a very tax efficient manner. QQQI also won the best new active ETF this year by ETF.com, so you know it's the real deal. QQQI has a dividend yield of around 14%, which is just insane honestly, and the expense ratio is pretty solid at 0.68% as well. The holdings are based on the Nasdaq 100 index, where its top holdings are the usual of Apple, Nvidia, Microsoft, Amazon, Broadcom, and Meta. The top sectors are technology followed by communication services, consumer cyclical, consumer defensive, and even healthcare. So yes, you have diversification in this one fund of QQQI. This fund is a great choice for investors who want stable and sustainable monthly income in their portfolio, which is what this fund provides to investors. Now, the returns of QQQI in the last year has not only beaten JEPQ, but has also beaten SCHD as well, which is pretty insane, making this fund a solid choice for investors in a bull market and a very strong long-term hold while taking in that sweet passive income every single month. Now, if you want to see legit a full breakdown of these two funds of SPYI and QQQI as well, you can see it right here on my channel right now. Our third ETF on this list is a sleeper, and that's T-SPY Tap Alpha's SPY Growth and Daily Income ETF. Now, if you love investing in the S&P 500 and want monthly income, high income, and some solid growth in your portfolio from the S&P 500, then T-SPY might be exactly for you. T-SPY is a fintech-powered fund that captures S&P 500 performance and daily potential income generation, a dividend investor's dream. T-SPY does this because they want real shares of SPY, which is basically a direct tracker of the S&P 500 long term. So not only do you get exposure to SPY or the S&P 500, but you also get exposure to that high juicy monthly income from premiums every single month, of course. There's also a maximized time decay where T-SPY writes call options each day, so every single day they go in, write those call options that expire that same exact day. Where T-SPY does this to capitalize on the rapid time decay inherent to zero DTE option positions for that high juicy income and solid upside exposure for capital appreciation long term. Additionally, you also get reduced time risk from zero DTE call option strategies and flexibility as well to adapt to various market conditions with T-SPY to get the best possible performance in your portfolio through T-SPY. This fund by Tap Alpha also has that same tax benefit of index options, just like NEOS, where you guessed it, T-SPY is also taxed at lower taxable rates than JEPQ and even other covered call funds from that lower 60/40 tax rate of lower income tax rates in your portfolio with T-SPY. T-SPY has a dividend yield of around 15%, which is just mind-blowing, yet it's also a very sustainable yield, and the expense ratio is 0.68% as well. Now, we already went over this, but T-SPY holds the S&P 500 through the SPY ETF, so only through one holding of just SPY. So just like any other fund based on the S&P 500, you have diversification to every sector in the stock market, and the top dogs from this index, of course, in T-SPY. The returns of T-SPY have been super solid and just mind-blowing in the last month in a rising equity market where it's outperformed and beaten both the JEPQ and even SCHD as well. And so far this year, T-SPY is also outperforming and beating both SCHD and JEPQ once again, so long term, I think T-SPY is going to be a powerhouse of a fund, and long term it's a great holding in your portfolio, in my opinion, for high monthly income and even growth as well. Now, if you want a complete breakdown of T-SPY, you can check it out in this video right here that I made for you guys. Up next, we have two ETFs that are better than SCHD, all in my opinion. Our first ETF is Capital Group's Dividend Value ETF of CGDV. SCHD is a sleeper fund only because SCHD is a passively managed index or a fund where Capital Group basically goes in and actively manages the portfolio, so you have that benefit of generating hopefully more alpha long term with SCHD to hopefully beat SCHD as well from active management. On their website of Capital Group, it says that SCHD seeks to produce consistent income to investors. The fund does this by focusing on companies that pay dividends or have the potential to pay dividends in the future. So with SCHD, you're going to have more higher yielders that might not have more growth long term, where SCHD is going to hold those large cap companies mostly that have dividends or potentially that can pay dividends for hopefully more upside potential and growth long term for the best total returns in your portfolio from SCHD. Another benefit of SCHD is that up to 10% of assets in the fund can be invested in stocks of larger companies outside of the USA. So basically, you can have potentially international exposure for more diversification than something like just holding SCHD, because SCHD can also hold international companies. This fund also holds 52 different companies, where its top holdings are Microsoft, RTX Corp, Broadcom, British American Tobacco, and even Eli Lilly. The sector holdings are once again, you guessed it, well diversified. The dividend yield is around 1.5%, so very low compared to SCHD, so that's going to be one zonk, but the expense ratio is also going to be higher as well, which is another zonk compared to SCHD of 0.33%. Now I know what you're thinking. Why would I pay a higher fee and even have a lower yield than SCHD? Because SCHD has active management to hopefully generate more alpha and higher returns, which you're going to see right now. As you can see, SCHD has crushed both SCHD and even JEPQ for its total returns over the last 3 years, so this fund is the real deal of SCHD, so keep it on your radar for investors in the stock market who want dividends and even growth as well in their portfolio. Our second ETF is going to be Fidelity's high dividend ETF of FDVV. What I love about FDVV is the fact that the dividend yield keeps up with SCHD at 3%, where SCHD is at 4%, and also that the fund also invests in high quality dividend paying companies for decades to come, which is also a great benefit of FDVV. This fund of FDVV is a touch just a little bit more diversified than only buying SCHD, since it holds large caps, mid caps, giants, and even small cap companies as well, so it's going to be more diversified than just buying SCHD. The sector exposure is, first of all, very diversified once again. This fund invests in 100 different companies, where its top holdings are ones that you might know and love, like Apple, Microsoft, Nvidia, JPMorgan Chase, and even Philip Morris International. The cool thing about these two funds of FDVV and even SCHD is that you also invest in more growth stocks, so that's why these funds can also beat SCHD long term, because you have more growth stocks than value stocks compared to just only buying SCHD. The dividend yield is around 3%, where the expense ratio is exactly 0.16%. Once again, no ETF is perfect, and I want to give a shout out to SCHD for having a better dividend growth over the past few years and even over the past decade than only buying FDVV, and even a higher starting dividend yield, so that's great for SCHD lovers. The performance of FDVV has been super amazing and very solid, where it's actually beaten SCHD over the last 5 years, which is a great accomplishment for FDVV. Now, if you guys want to see my entire ETF portfolio, exactly all the holdings from my top holding of VU, SCHD, DGRO, SCHG, and so many ETFs in my portfolio, you can see it for completely free on Blossom. You get to see my portfolio, my buys, and so much more in this one app for free for investors. Yes, free. And you can also get free money. Once again, you can also earn money from learning about ETFs all in this one app. And it's a great app for investors who want to learn about the stock market or just share your portfolio with other investors as well. What are you waiting for? Go ahead and check out the link in the description of this video or in the pinned comment section, and I will see you all there on Blossom. Now, if you guys like this video, please give it a like because this cute puppy did. Now, if you want to see my interview with the CEO of Tap Alpha of T-Spy, you can check it out right here to learn more about T-Spy, and also my interview with the co-founder of Neos Investments of Troy Cates. Check it out in this video right here to get a full breakdown of both SPYI as well as QQQI, crushing the stock market, and take it easy. I love you guys so much. Peace.